Welcome to Ultimate Learning Hub, which is the hub of transformation. In this session, we are going to look at the first topic in financial accounting, which is known as accounting framework. Accounting framework will be the first chapter that we'll be looking at in financial accounting. Now, in this subject of accounting framework, or in this chapter on accounting framework, it has got three major subtopics in it. The first subtopic is introduction to financial accounting. The second subtopic is conceptual framework, and the third subtopic is regulatory framework. Introduction to financial accounting will be covered in this session. So we'll have three sessions in this topic of accounting framework. So session one will cover, or which will be our part one, will be introduction to financial accounting. Session two will be conceptual framework, which will be part two. And session three, we will cover regulatory framework, which will be part three. Now, in starting with part one, which is our 2 days session, introduction to financial accounting, we need to define what financial accounting is. So what is financial accounting? Financial accounting is basically a branch of economics which involves gathering, recording, summarizing, and presenting information to the different users of financial statements. So it's a process that involves gathering, recording, summarizing, and presenting information to the various users of financial statements. We also have another accounting which is known as management accounting. So there are two major types of accounting. Accounting is basically divided primarily into two: financial accounting and management accounting. Management accounting, on the other hand, are accounts that are prepared to assist managers in their decision making. Accounts that are prepared to help managers in their decision making. The reason for preparing management accounts are three. Number one, to help managers in planning. Number two, to help managers to control. And remember, control involves comparison of the plan to the actual performance to get the difference, which is known as a variance. And number three, to assist managers in their decision making. So there are two major branches of accounting, which is financial accounting and management accounting. Our focus currently is on financial accounting. Now, what are some of the differences between these two branches of accounting, financial accounting and management accounting? For the purpose of this study, we look at 6 differences between financial accounting and management accounting. And the differences are put in a table form. The first difference is on the users of the accounts. Who are the users of financial accounts and who are the users of management accounts? For financial accounts, it's basically for the external users or external stakeholders, those found outside the company, like the government, the creditors, the lenders, and any other, maybe the banks, etc. Those are external stakeholders or external users. They are the people who are factored in mind when financial accounts are being prepared. On the other hand, management accounts are for internal users. That is the managers and other employees within the organization. That means management accounts should be used only within the company. The second difference between FA and MA is on the purpose of financial statements. Why do we prepare financial accounts? There are 4 major reasons why we prepare financial accounts. Financial accounts preparation helps, number one, to show financial position of the business. What assets do you have? What liabilities do you owe? And what is your equity status? Number two, it helps show financial performance of the business. How did the business perform? What is the bottom line? Did the business make profit or did the business make a loss? Number three, it helps show changes in financial position of the business. What is the movement in the equity of the business? And number four, it helps show the cash position of the cash status of the business. Those are the 4 major reasons of preparing financial accounts. In other words, the purpose of financial accounts. On the other hand, in management accounts, as we have looked at it before, management accounts serves 3 purposes: to help in planning, control, and decision making. The third difference between FA and MA is on the nature of accounts. Financial accounts are purely financial. In other words, they are quantitative in nature. On the other hand, management accounts are both financial and non-financial. In other words, they are both quantitative and qualitative in nature. The fourth difference is on the format. Now, when you are preparing financial accounts, there is what we call accounting standards that we follow in the preparation of financial accounts. The accounting standards will dictate the format to be followed in preparation of financial accounts. If it's public sector accounts, we follow what we call IPSAS, International Public Sector Accounting Standards. And if it's in the private sector, we follow International Financial Reporting Standards or the International Accounting Standards. On the other hand, management accounts does not have a standard format. It's upon the management to decide on the format to be followed in preparation of management accounts. The fifth difference between FA and MA is on the legality, the legal status. Financial accounts, there is a legal requirement that all limited companies must prepare financial statements or financial accounts. On the other hand, there is no legal requirement for management accounts. The last difference for our session is on time. Financial accounts are only prepared for the time that is past. In other words, they are historical, while management accounts are both historical and future-looking. In other words, if you want to prepare budgets, which are management accounts, you'll use information in the past to enable you focused on the future. So basically, these are the 6 differences between financial accounts and management accounts. The first difference is on the users. The second difference is on the purpose. The third difference is on the nature. The fourth difference is on the format. The fifth difference is on the legality. And the sixth difference is on the time period. Now, in financial accounting, you must know the different forms of businesses. We have basically 3 forms of businesses, but we can also add other forms which are not major. The first form of business or type of business is what we call a sole trader business. This is a business that is owned by one person, and that one person is known as a sole trader. Sole trader is not legally separate from the business. There is a concept as we wind up on this session, which is known as business entity concept. So we are being told that in a sole trader, they are not legally separate. In other words, the person and the business are one in a sole trader relationship. The second form of business is what we call a partnership. A partnership is owned by 2 or more persons that are known as partners. Partners are legally not separate from the partnership, just like in sole traders. In other words, you cannot separate the two. You cannot split the partnership from the owners of the partnership. The third form of a company is what we call, form of a business, is what we call a company. A company is a legally separate business owned by 2 or more persons, and these persons are known as shareholders. So in this form of business, it is legally separate. So we've looked at 3 forms of business: a sole trader, which is owned by one person, and it is not legally separate. Number 2, a partnership, which is owned by 2 or more partners or persons, and these partners are also not legally separate. And number 3, a company, which is legally separate, which is owned by 2 or more persons, and these persons are known as shareholders. But we also have other forms of businesses, and the other forms of business can be, number 1, cooperatives. In cooperatives, there are members who come together to start a business to satisfy their objective, or what we call common interest, or their needs. So these are people who come together with an objective to help them meet or satisfy their objective or common interest. We also have non-profit making business entities. They are started to just offer a given service or good, but their main purpose is not to make profit. They are not motivated by profits. However, they may have some surpluses or deficits, but their objective is not to make profit. And also we have parastatal as another form of business, and a parastatal is a company that is fully 100% owned by the government, even though sometimes the government can just have a percentage stake in the parastatal, but they must have majority ownership. So there are basically three forms of business: sole traders, partnerships, companies, but other forms of business includes cooperatives, not-for-profit making organizations, and parastatals. Now, what are the different financial statements we normally prepare? There are 4 financial statements, or what we call components of financial statements, that you need to know how to prepare. Number 1, there is what we call income statement. Income statement is a statement that is prepared to show financial performance of the business. What are the profits that the business makes? What are the losses that the business has made? That's the first financial statement. The second financial statement is what we call statement of changes in equity. This statement shows movement in the equity of the business. Remember, the equity of the business is the capital of the business plus the reserves. So if there is any movement in the share capital of the business and also any movement in the reserves of the business, these are shown through statement of changes in equity. The third financial statement is statement of financial position, what is commonly known as the balance sheet. The balance sheet shows the position of the business at the end or as at any given period. What are the assets that the business has? What are the liabilities that the business owes others? And what is the equity of the business? That is statement of financial position. And finally, statement of cash flow. What is unique about statement of cash flow? The first 3 financial statements follows what we call accruals concept. But this fourth financial statement, it follows what we call cash concept. So statement of cash flow is a statement that shows the cash position of the business, the cash position of the business. Now, elements of financial statements. We have 5 elements of financial statements. The first element is what we call assets. Assets are basically what the business owns. In the next session on conceptual framework, we'll be defining these elements into details. So basically for now, assets are what the business owns. But in conceptual framework, when we are defining assets in details, we'll see that these are resources controlled by the business entity as a result of a past event. And there must be future economic benefits to flow to the business. For now, let's just know assets as what the business owns. The second element of financial statements is liabilities. Liabilities are what the business owes others. Our obligation to others, our obligation to suppliers, our obligation to creditors, etc. The third element of financial statement is what is known as capital. Capital is owner's contribution to the business. How much did the owner bring to the business? The owner's contribution is what is known as capital. The fourth element of financial statements is what we call income. Income is what the business generates. What comes in, the inflows to the business, that is income. What you collect from your customers, that is called income. On the other hand, what you spend on is the fifth element, which is known as expenses. Finally, there are accounting concepts. There are different concepts and assumptions we need to learn in accounting framework. The first concept, which is the primary concept, is what is known as accruals concept. Accruals concept is, it normally states that for incomes, we should recognize income when it has been earned. When we earn income is when we recognize it, but not when the cash is collected. While for expenses, expenses should be recognized when they have been incurred, but not when cash is paid. That is accruals concept. Accruals concept tells us we should recognize income when it is earned, but not when it is received, cash is received. While for expenses, we should recognize them when they have been incurred, but not when cash is paid. The second accounting assumption or concept is what we call going concern. This is the assumption that the business will be in operation in the foreseeable future. This is the assumption that the business will be in existence tomorrow and the day after tomorrow. Now, assumption number one, which is accruals concept, cannot exist without going concern, because we need going concern in order to have accruals concept. In other words, for us to sell to a customer in credit, we must assume that the customer will be there tomorrow. In other words, there will be a going concern. So we cannot operate without a going concern. The assumption that the business will be there tomorrow and the day after tomorrow. The assumption that the business will be in operation in the foreseeable future. The third concept is known as prudence concept. So basically, to be prudent is to exercise a degree of caution, to be cautious, to be careful when making any decision. So prudence concept basically states that where alternative procedures or valuations are possible, the one chosen, the one that you will choose as an accountant, should be the one that gives the most cautious presentation of the business financial position. In other words, when we have different options, the option that you choose is the one that gives a cautious approach when you are presenting the financial position. To be prudent is to exercise a degree of caution. The fourth concept is consistency concept. Consistency concept, on the other hand, states that in preparation of financial statements, consistency should be observed. And consistency has got two approaches in it. Number one, similar items should be given similar accounting treatment. When items are similar, they should be accounted for in the same way. And the second approach, same transactions, really not an approach. The second way to explain consistency, same treatment from one period to the other. To be consistent, the way you account for an item in year one is the same way you account for an item in year two, unless there is a need to change the approach. The next concept, which is concept number 5, is business entity concept. Business entity concept, accountants regard businesses as separate entity distinct from others, apart from only sole traders and partnerships. So in other words, the business and the person running the business are two different entities. They should not be assumed to be one. And finally, there is materiality concept. So under materiality concept, it talks about significant. Information is material if its omission or misstatement can influence economic decisions of the users. We should only account for transactions if they are material. So what is materiality? What does the materiality concept tell us? That information is material if its omission or misstatement will affect the economic decision of the users. That brings us to the end of the first part of accounting framework. So part 1 was looking at introduction to accounting framework, where we have looked at what is financial accounting, what is management accounting, what are the differences between financial accounting and management accounting, what are the elements of financial statements, what are the components of financial statements? And finally, we have looked at what are the accounting concepts. So that's the first part, or the first session of accounting framework. In our next session, which will be part 2, we'll now look at what is known as conceptual framework. Thanks for your attendance of this session on Introduction to Financial Accounting Part 1. Let's meet for our next session. Welcome, or thank you for attending the Ultimate Learning Hub, which is the hub of transformation. Thank you.